Bitcoin is once again at a critical stage. The cryptocurrency, after experiencing a period of strong upward movement during the last few months, is now showing the first real signs of fatigue. The price has reached a zone of resistance that has proven difficult to overcome, and several technical indicators are suggesting that buying momentum is weakening. This slowdown is not yet a confirmed reversal, but it represents an important warning signal for traders and investors who have grown accustomed to steady price gains. At the time of writing, Bitcoin is trading between approximately $106,500 and $112,000. This zone has formed a clear range, with repeated price rejections near the upper level and buying interest near the bottom of the range. The market remains undecided, waiting for new data or a strong catalyst to break the current consolidation. Bitcoin dominance, which measures its share of the total cryptocurrency market capitalization, is rising again. A rising dominance usually means that Bitcoin is performing better than the broader altcoin market. It often happens when investors reduce exposure to smaller assets in favor of Bitcoin's relative stability. The current dominance trend suggests that traders are taking a defensive approach, moving capital from altcoins to Bitcoin or stablecoins. This has resulted in weaker performance for assets such as Ethereum, Solana, and XRP, which are showing limited momentum and lower trading volume compared to recent months. From a broader perspective, global risk sentiment also affects this setup. Equity markets have become more cautious, and several economic indicators point to slowing growth. Central banks, including the U.S. Federal Reserve, are now balancing inflation control with maintaining liquidity in financial markets. For Bitcoin, these macro factors are important because they influence the flow of capital into or out of risk assets. A more restrictive environment reduces liquidity and can pressure cryptocurrency prices, while an easing phase often brings renewed buying interest. Currently, the environment appears neutral but uncertain, increasing the likelihood of volatile reactions to any policy change or major market event. The bottom line is that Bitcoin's long-term trend is still technically bullish, but warning signs are visible. The market has reached a stage where caution is justified. Investors should pay close attention to how price behaves within the current range, as a confirmed breakout or breakdown will likely determine the next major direction. The technical picture on Bitcoin's charts presents both optimism and concern. On the weekly time frame, Bitcoin remains above all major moving averages, indicating that the macro uptrend remains intact. However, when looking closer at the Relative Strength Index, RSI, and MACD indicators, we see divergence. The RSI has started to form lower highs while price action has held near the top of the range. This is a textbook sign of weakening momentum. The MACD histogram is also flattening out, showing that buying pressure is slowing. The super trend indicator, which reacts to volatility and trend strength, is still green on the weekly chart. This means that for now, the broader bullish trend remains valid. But when a trend begins to lose strength near an overextended zone, traders often prepare for a corrective phase. That does not necessarily mean a large crash. It could simply mean a multi-week cooling period. On the daily chart, Bitcoin is facing firm resistance near $110,800 to $111,000. This level acted as strong support during previous rallies but has now turned into resistance. When a former support becomes resistance, it confirms that market sentiment has shifted in the short term. Each time Bitcoin approaches this level, sellers appear and volume increases on the downside. The 6-hour and 4-hour timeframes show a very clear horizontal structure. Price continues to fluctuate between $106,500 and $112,000 without establishing a new trend. The lack of direction is typical of distribution or accumulation phases, where large market participants either build or reduce positions quietly. The key is to observe the breakout direction once the range ends. A potential head and shoulders pattern is forming on the midterm chart. The left shoulder was created during the first rally failure, the head at the recent high, and the right shoulder is forming now. For this pattern to be confirmed, the price must close below $106,500 and stay there with consistent selling pressure. If confirmed, the projected target based on pattern depth could bring Bitcoin closer to the $95,000 to $98,000 range. However, if price holds above $106,500 and breaks $112,000 instead, this pattern becomes invalid. At the moment, the formation is incomplete, so traders should not act on it prematurely. The liquidation heat map reveals where large clusters of stop orders and leveraged positions are located. Most liquidity currently sits around $106,000 to $106,200. Markets often move toward liquidity because that's where many traders have placed stops or limit orders. A sweep of that area would not be unusual. Above the market, liquidity accumulates around $111,700 to $116,000, suggesting that if Bitcoin manages to break resistance, it could quickly move toward the upper liquidity zone before facing new selling pressure. From a risk management perspective, $106,500 remains the most critical support level. A breakdown below this level would not only confirm the head and shoulders pattern, but would also invalidate several short-term bullish signals. In that case, traders might see increased volatility as liquidations trigger. On the other hand, a daily close above $112,000 would suggest that buyers have regained control, opening potential upside back toward $115,000 and beyond. Overall, the technical structure can be summarized as stable but fragile. The market is balanced between cautious optimism and growing weakness. Momentum indicators warn of a possible slowdown, while price action still maintains support. Traders should monitor volume and volatility closely, as the next move is likely to be sharp once the current range resolves. Altcoins are showing clear weakness relative to Bitcoin. Rising Bitcoin dominance typically means that traders prefer the relative stability of Bitcoin during uncertain periods, and that is visible in current data. Ethereum, Solana, XRP, and Chainlink all show lower volatility but also lower strength. Ethereum continues to form lower highs and lower lows, indicating a mild downtrend. The price currently trades near $3,800 and has struggled to stay above resistance levels around $3,950 to $4,100. The structure on the daily chart suggests indecision. Buyers are active near $3,720, but every attempt to push higher has met with profit-taking. Volume on Ethereum's spot market has also declined, which shows that traders are hesitant to commit new capital, while Bitcoin remains in a consolidation phase. Solana is experiencing similar pressure. The price has repeatedly tested the $190 to $200 resistance area but failed to break through. This zone has become a ceiling, while support lies near $177 to $179. The network remains active with daily transaction counts high, but price action does not yet reflect fundamental strength. If Bitcoin experiences further weakness, Solana could test $170 or even $158, areas that correspond to previous demand zones. A confirmed daily close below $177 would turn the short-term outlook bearish. XRP, after its recent recovery phase, has entered another period of sideways movement. The token is trading between $2.30 to $2.40 on the lower side and $2.60 to $2.70 on the upper side. While the range offers opportunities for short-term traders, the bigger structure remains bearish on the weekly chart. The RSI on XRP is declining, and moving averages are flattening, signaling a lack of strong direction. For XRP to regain momentum, it would need a sustained move above $2.70, supported by higher volume. Chainlink follows a similar pattern. Its price fluctuates between $16.50 and $17.50, facing resistance near $19 to $20. The trend is slightly negative, and the coin appears to be consolidating. Without a strong recovery in Bitcoin, LINK is unlikely to break this range. Investors remain cautious, and daily trading activity has slowed significantly compared to earlier in the year. Overall, the altcoin market reflects investor caution. When Bitcoin trades in a range, most altcoins either stagnate or decline gradually. Only coins with strong independent catalysts tend to outperform, and currently, there are few such catalysts. Unless Bitcoin breaks out to the upside, it is unlikely that altcoins will show significant improvement. The short-term outlook for Bitcoin and the broader cryptocurrency market is one of uncertainty mixed with caution. The key levels remain unchanged. Support near $106,500 and resistance around $112,000. A confirmed daily close above resistance would suggest a continuation of the bullish trend, while a close below support would confirm a new downward leg. Until one of these two events happens, the market is likely to remain range-bound. Traders should recognize that sideways markets can persist longer than expected. During such phases, liquidity often compresses, leading to sharp breakouts when one side finally gives up. The best approach is to wait for confirmation rather than anticipate direction. Entering large positions inside the range exposes traders to false breakouts and quick reversals. From a macroeconomic perspective, several factors could influence the next move. Interest rates, inflation expectations, and global liquidity remain key. If the Federal Reserve signals a more dovish policy stance or begins rate cuts, liquidity could return to the market, potentially supporting risk assets like Bitcoin. On the other hand, if inflation rises again or yields increase, investors may reduce exposure to cryptocurrencies. Bitcoin remains one of the few digital assets with consistent institutional interest. Exchange-traded funds, ETFs, have improved access for large investors, creating a new source of demand. However, short-term corrections are normal even in strong markets. The warning signs currently flashing on charts do not necessarily indicate a crash, but suggest that a corrective or consolidation phase may be ahead. Altcoins are expected to remain weak until Bitcoin shows renewed strength. Ethereum may continue sideways trading, Solana could test lower levels, and XRP may remain inside its current narrow band. Traders focused on altcoins should monitor Bitcoin dominance. If dominance continues to rise, it will likely suppress altcoin performance further. Risk management remains the most important aspect of trading in the current environment. Avoid using high leverage, set clear stop-loss points, and respect technical levels. In markets where liquidity is building below price, downward spikes can happen quickly and trigger liquidations. Traders should plan for such scenarios rather than react emotionally when they occur. In summary, Bitcoin is flashing caution signals, but not yet a reversal. The trend on higher timeframes remains positive, but momentum is fading. Altcoins are showing weakness and will likely continue to follow Bitcoin's lead. The market is waiting for a decisive move beyond the $106,500 to $112,000 range. Until then, patience, disciplined risk control, and careful observation are the best strategies. If Bitcoin manages to hold above support and reclaim $112,000, a rally toward $115,000 to $118,000 could develop. However, if price breaks below $106,500, traders should prepare for a move toward $100,000 or slightly below. The next 2 weeks are likely to determine which direction the market chooses. For now, the message from the data is simple. The warning signal is active, liquidity is building below, and traders should stay alert. The larger bull trend is not broken, but the short-term outlook requires caution and discipline.